All right, let's keep going. Transaction on December the 20th, NetSolutions paid $900 to Executive Supply Company on the $1,800 debt owed from the December 4th transaction. So if we go back to slide 33, NetSolutions purchased some office furniture, and they purchased it on account. Okay, so when that happened, we got some office furniture here as our debit, because office furniture is an asset, and then we had an accounts payable for $1,800. I don't want to go back 7 slides to find that. But now, 16 days later, we're going to pay half of our debt. Okay, so when this happens, our cash asset has gone down by $900. But there's no impact on stockholders' equity because liabilities have also gone down by the same $900. Again, if you want to review that transaction, it's back on slide 33. Okay. Says on December the 21st, NetSolutions received $650 from customers in payment of their accounts. Right, so a couple slides back, we said that NetSolutions had earned $1,750 for services provided, and that we had set up $1,750 in accounts receivable. We also, or I mentioned at the same time, that we didn't know if that $1,750 was from one client or more, and we still don't actually. But what we do know now is that part of that $1,750 that was owed to us has now been satisfied. We've received cash of $650, okay, which means that cash goes up by $650, but it also means that accounts receivable needs to go from $1,750 down to $1,100, okay, because we originally were owed $1,750 on accounts receivable. Now we've been paid $650 of that. That leaves an $1,100 balance in accounts receivable. So in order to make that happen, accounts receivable, which has a normal debit balance, must be credited for $650. The accounting equation impact, there is none. One asset has gone up by $650, cash. Another asset, accounts receivable, has gone down by $650. The full $1,750 benefit to stockholders' equity was recognized at the time the services had been performed and the revenue had been earned. Now we're just collecting on an accounts receivable. The fact that we're getting cash does nothing to increase stockholders' equity. We can't double dip and increase equity twice. Does that make sense? Okay. So assets go both up and down. All right, paid for supplies. On December the 31st, NetSolutions paid $1,450 for supplies. This is pretty straightforward. Now, if you recall, earlier back in November, they bought supplies on account for $1,350. That's not what we have going on here. Here they're buying supplies and they're paying for them. So supplies is an asset, and that we've increased that asset account with a debit for $1,450. Cash has gone out. We decreased that asset account by the same $1,450, and we have the exact same thing that we had on the previous slide, just using different accounts. One asset, cash, has gone down, but another asset, supplies, has gone up, so there is no impact on stockholders' equity. All right, we paid some wages back on December the 13th, and 2 weeks later, on December the 27th, they paid a receptionist and the part-time assistant, this time $1,200 for 2 weeks' wages. Pretty basic here. Wage expense, as all expenses, increase with a debit. Cash has gone down, so we're going to credit it. We have a direct decrease to stockholders' equity. The expense has gone up, so stockholders' equity has gone down. All right. Another little example of a bill here. Transaction paid telephone bill. This is just the same as a wage expense. Expenses go up with a debit. Cash has left the building. It goes down with a credit. So again, I can't emphasize this enough because I don't want you to get confused. I'd rather you be bored than confused. Okay? It's the expense that has increased here. Stockholders' equity has gone down by way of that expense. So the way this slide is done can be a little bit confusing, but if you think about this, and if you actually think about it and use your brain, you can make sense of this. If you just try to go by what the arrows say and you don't put any thought into it, well, then that's how you might get confused. All right. So it looks like we had paid a phone bill before. Now we're paying an electric bill, and it's $225. Exact same thing as we had on the previous slide. Just a different account, slightly different account. Well, actually, the purpose is different. The accounts are the exact same, and the amount is a little bit different. Okay. Looks like we have a familiar transaction here. They provided some services that were worth $2,870, and they received cash for those upon completion, so therefore cash goes up. The income statement side of a revenue transaction, we're calling it fees earned. Revenue, same thing. Cash goes up, revenue goes up. Revenue goes up, however, with a credit. So the accounting equation impact, assets go up, and in this case, different from expenses, revenue goes up and stockholders' equity go up. Okay, so when we have revenue here, both the revenue is up and stockholders' equity is up. When you see expense here, the expense is up over on this left side, but equity actually goes down. Okay? And let's see what we have here. On December the 31st, fees earned on account totaled $1,120 for the second half of December. So we're just setting up another, we're just increasing our accounts receivable. These are, we had some transactions that occurred in the first half of the month that were for $1,750. Now we've said, okay, from December the 16th through the 31st, we had $1,120 in services that we provided, but we don't have the money yet. So we increase accounts receivable and asset account with a debit for $1,120. Again, whether it's cash or accounts receivable, this fees earned revenue account entry will be the same. And the accounting equation impact will be the same. Okay, we're going to increase stockholders' equity now. When we get the cash later and we convert this receivable amount into cash, there will be no impact on stockholders' equity. And looks like on December the 31st, we are doing the same thing we did back in November. We're going to pay dividends of $2,000. This is an owner draw, essentially. So Chris Clark, the guy that owns the company, he put $25,000 in, but guess what? He didn't anticipate that $25,000 was going to stay in the company forever. He's going to, as the company earns revenue, he's going to get all of his money back, right? So when the payment of this $2,000 plus the other one, he now only has $21,000 in the company, okay, as an investment. So dividends go up as cash dividends are paid because cash is going down, right? Let's see what we got here. Dividends go up, cash goes down. What do you think happens to stockholders' equity? I already told you. It goes down. Cash dividends paid decrease owners' equity. All right, so what we have here is a trial balance. This is called an unadjusted trial balance. And when we post journal entries to the ledger, every time we do that, every time an account is impacted, the balance of that account will go up or down, depending on what the transaction is. So here we have some other journal entries that we're going to have to make at some point called adjusting entries. And we actually had a little bit of an adjusting entry with the supplies when we reconciled the supplies at the end of November. But this is the unadjusted trial balance for the month of December. Okay. So if we look down through here, we have cash, accounts receivable, supplies, prepaid insurance, land, and office equipment. All of these have debit balances. The reason is because they are asset accounts. Let's see here. We may have missed a transaction somewhere in there. I think we might have. Accounts payable, unearned rent. I'll come back to that one. Well, I'm not going to come back to it. There was a transaction that I may have skipped over for $360. We had purchased this land here, and I guess what we're doing now is we're renting it out. And I guess we're renting it out, if I recall, for $120 a month, and we took a $360 advance payment. But we did that, I want to say at the end of December, so I think I may have missed that slide. And so we've received the money, but we haven't actually earned any of it yet. So this unearned rent here is a type of unearned revenue. That is a liability, therefore those have credit balances. Common stock is the same $25,000. The fact that he has taken out dividends does not change the common stock account whatsoever. We set common stock up with a credit when we got the cash. It is still going to be a credit. Dividends now total $4,000, which is a debit amount. Revenues, all of those transactions from the $7,500 all the way through the $1,120 transaction that we had, total $16,340 credit amounts. Look at our expenses. All of our expenses are right here, and they are all debit balances. And notice that our debit balance is $42,600. Our credit balance is $42,600. If I accidentally skipped over some of these transactions and you're a little bit confused, I do apologize. Those little arrows, sometimes I get a little bit jumpy and I might accidentally skip over something. But the point being is that this trial balance needs to do just exactly that. It needs to balance, and it does. So for now, we're okay. All right, let's look at a couple of things though that can happen. In the next, we're gonna go ahead and end this video, and then the next video we're going to look at some reasons why, even though these figures here balance, life may not be perfect in the accounting world. All right.